Hello and welcome to Unqualified Advice, an entertaining show for entertainment purposes. Join us as we talk about running our businesses, what we've been learning, and how we're applying lessons from academia and real life as entrepreneurs and investors. This podcast is for informational purposes only. Topics discussed represent opinions represented by parties with different circumstances than your own and should not be taken as advice. Any discussion of securities or other investments should not be relied upon as investment advice. Consult your personal financial advisor and perform your own due diligence. Podcast hosts, guests, and clients of Fig Social Capital may own positions in securities discussed in this podcast.
Let's dig into our ideas here this week. So
I think a great place to start would be going back to, you had sent me a text a while back of you had sort of posed this same sort of question, the broad question to, let's call it, the normal everyday person who has some exposure to the market, largely through retirements, but doesn't really, if you ask them to define a stock, they probably would struggle. They probably get close, but they probably struggle to get a real definition going. But this defines the majority of all participants in the market, right?
It really truly does.
On a numbers basis, right? Maybe not probably dollar denominated.
No, dollars. Yeah, absolutely dollars too.
Yeah.
I think. I think if you look at, it was a Morningstar piece I read doing some research for this. I wish I'd put that link here, but I believe 3/4 of the total mutual fund ETF market has converted to passive investing styles now, which I think makes a lot of sense. And as we'll get into what exactly that means and why that may be good or bad and what impact that is having on the investment market in a broader context as a whole, I think is where ultimately we'll weave through. But yeah, so I think you're right. So what, when we say what is
successfully or unsuccessfully, we are
successfully or unsuccessfully here. But when we say what do we mean when we say active versus passive? So I think maybe thinking about some examples to help kind of elucidate this. When we're talking about a well-diversified passive investor, would be somebody who is periodically coming in every month, essentially, or every paycheck, taking a set percentage out of their check and sticking it into their 401k, where it's probably put in a target date fund, more likely than not. And that is one of the largest passive vehicles out there. What those target date funds are doing is saying, here's a basket of global equities, bonds. They have, because they're investing as an institution, they have some funds that are maybe more private access type of thing that you're not going to necessarily be able to go out and get access to if you in your own personal brokerage, unless you're an accredited investor. But there'll be some aspects of that in those. And what is happening ultimately is that they're basically buying everything in the market, but in differing proportions. And people are putting their money in every week without thought to what am I actually putting in, and not caring, and that's okay. And that ultimately, that really, I think, is an okay thing. It's not a problem at all.
Absolutely.
It just creates interesting dynamics around. For those of us to think more in depth about it, it creates interesting dynamics for us to quibble about, essentially. But ultimately, passive investing in a vehicle would be like buying the SPY in ETF, which is iShares, I believe. Or VOO, which is Vanguard's S&P 500, where as you buy a share of that, they're taking that $440 share and saying, we're buying a little bit of each one on our market cap weighted basis. So if Apple is the biggest proportion of that index that day, then you're going to get more shares of Apple relative to the smallest company, maybe, I don't even know. I don't know, BRO or somebody.
Yeah.
Who's number 500? What's the 502nd smallest smallest market cap weighted stock in there? I do not know right off the top of my head.
And the beauty of this is that you're buying the best 500 companies that exist in the United States or traded in the United States.
Mm-hmm. And
it's automatic diversification.
You need most of the literature I've read on the academic side says you really need about 30 stocks to consider it a diversified portfolio. And now, of course, there's things that could break that. You could have 30 stocks that are all very tightly correlated around the same thing. That breaks. But if you have 30 stocks that are from varying industries, sectors, you don't want to have all just 30 AI stocks. You want to have a few telecom, a few healthcare, a few this, a few that. Then you get the benefits of diversification, where if there's a big, massive oopsie at one of these companies, essentially, and they lose 80% of their value overnight, okay, well, 80% of that one stock's value went down, but that's only about 3% of your overall portfolio's value. So you've maybe lost, 2.5%. So it really minimizes that impact that you feel. I hope I said that well.
You did, but I think it's also always important to sort of remark on the fact that you're also suppressing the upside, or not suppressing it, but like, you're reducing overall volatility, right?
Yes,
you're not going to lose that much. You're not going to gain that much. But the beauty of it is depending on where you put your lines in the sand, right? Like whether it's 1954 or 1980 or 2000, whatever, you'll get slightly different numbers, but it's somewhere between 6 and 11% that you're going to average per year if you just buy the S&P 500.
Absolutely, which is an amazing little,
which is a beautiful return.
Which is a beautiful thing that you can, on average, over 50 years bank on. That's nice to know. What happens though in getting to that average, there are periods though where you have a year down 60%, and so that is where people get scared away, and where I think passive investing really helps is that people are putting it somewhere, not thinking about it actively, not saying, oh, there was a better choice of this or that. They're just setting it and forgetting it, essentially, and that is ultimately the best decision they could make for themselves, in my opinion.
Yeah, because you've removed the thing that is the most common cause of losses, which is human psychology.
Exactly. Yeah. When you right now, you look at what Apple did from 2000 to 2020, just massive growth. But also there were some periods in there where they were down 80%. Or Amazon, after they initially IPO'd, I think they dropped 90%. At one point, they were worth pennies almost, and then look what they
Meta's gone through similar cycles. Yeah.
So it's when those drawdowns happen, people get scared and say, "Well, I'm out," and then they miss the, oh wait, here's the big
sold
uptick.
At the bottom.
They sell at the bottom.
Yeah.
They buy at the top. They sell at the bottom. And when you're passively investing, you're always putting a little bit in consistently, knowing that prices are going to fluctuate, and you what we call dollar cost average in to these positions that grow over time. So Nick Majuli has written some great things on the interwebs if anybody out there is interested.
So that's passive.
So that's passive. So like hold up, I wanted to have an example here.
That's an example of passive. I would go, like even if you're someone who kind of like dabbles, but you buy like 4 or 5 different ETFs and maybe mix the mixture up every so often, call it every year or something.
Mm-hmm.
You're still investing in, you might be slightly more active than the average, but like you are still investing in these big ETFs or mutual funds or something like that. And the way you and your actions get spread out, which is a benefit to you on average, in many ways, I think of that still as passive, because you are investing into vehicles that, like, I mean, you're not going to show up to the Tesla shareholder vote, right? Like, you're not going to be sending in paperwork defining whether Bob Iger gets to keep his job or anything like that, right?
Exactly. So and I think when I think of active, we were talking about people that are taking an opinion on the value of the company relative to its current price in the market. So we're looking at to say, is this company earning enough today? And I think it's going to earn enough tomorrow, and then the year after that, and the year after that, to justify what I'm paying out of pocket today. So if we talk one number,
isn't that a particular kind of active investor?
Yeah, that's a particular kind. You're absolutely correct, because there's. I'm sorry, you're right. This is a specific angle. I guess that I'm also.
It's an example. Yeah,
an example. Yeah, a specific example where you say, hey, this stock is massively undervalued because people don't realize that it is going to double its business next year, and that those increase in earnings mean that it's going to pay me back what I'm putting in today in a much shorter time frame than what the current price to earnings ratio would indicate. But or that's saying, hey, this stock is way insanely overvalued. Why are people paying this much money for whatever? Because it is not actually generating any revenue. A great meme stock example of that right now, I think, is DJT out there, where if you look at it on paper, it's a market cap of billions of dollars on like $20 million of revenue and $30 million of losses. It's how it makes no sense. The math just does not math.
In a few rare cases, that ends up working out. But
in a few rare cases,
it's a white swan. Yeah,
it's a swan of some sort, that's for sure.
Yes,
wearing a red hat, and so you can take the view of saying, hey, this stock is overvalued, so I'm actually going to go out and you own that? You own some of that stock? Yeah, give me some of that stock. Let me borrow that from you, and I'm going to go sell it today and take the cash. And then when you want it back, I'll go rebuy it and give it back to you. And I bet I'm going to end up making money on that trade. Essentially, I'm gonna borrow it, sell it at 400, and when you want it back and it's only $200 because you want to get out of the stock and you want to sell it yourself, I'll sell it back to you, or I'll get it back to you, and having bought it off the market at 200, and thus netting the $200 profit for myself. That's one way and the mechanics that happen when those transactions happen actually do help drive prices down or up depending upon other things going on. But the actual mechanics of shorting a stock do tend to drive those prices downward. So that helps influence and make sure that the market is what we call efficient overall. When you have people on both sides saying, well, that's too high, that's too low, you get a good market wisdom overall of approximately what the true value is. But there's times when people think that value is not actually correct, and that's when they're actively investing. Yeah, that's one example. So you obviously, I know you have some pretty good examples from your experience in history, Dan. What are some other good examples of active?
I can give, I'll give a couple of examples of active, but active basically is like, let's extrapolate out Sean's example here and just say like it's an individual, or it is a firm or some sort of vehicle that has taken a position in the direction of a particular investment, and they actively allocate their money that way. Usually, not always, it involves heavy research, boots on the ground, all kinds of stuff going on to make sure that they what they think they know is as close to the truth as they can muster, right? So, but it comes in so many different flavors, right? Like Sean just kind of went through a value investor's perspective. And these labels are squishy, right? So don't
very squishy.
Nail me to the wall on
words
it.
mean very little in this world.
Yeah, a growth investor, that's really squishy, might not care about fundamentals whatsoever, right? They might just believe in the growth story or have a vision of where the market is going to go, and the price on a particular company isn't reflective where they believe that company will go in the future. Or that industry will go in the future, or that material or commodity will go in the future, or currency for that matter. Macro investors might look heavily into geopolitics or elections. There's a whole bunch going on, right? But at the end of the day, they are taking extremely, maybe I want to revoke the word extremely there, but they're going to amass positions in whatever instruments that reflect their thesis.
Mm-hmm. That is. They have an opinion, and then they find something to trade based upon that opinion.
Mm-hmm.
Oh, you think this is going to happen? Well, what's the trade? If that's going to happen as you think, if the world's going to do this as you think, that means that there's something is going to change in the current equilibrium from where it is today to a future state. And where do you want to be on that side? And what do you want to buy or sell as that equilibrium changes? I think
exactly
right.
Yeah. And so the research would tell us that most of us individuals, lovingly referred to as retail investors, if we try to trade actively, we on net lose way more money.
Absolutely correct.
If we would have just gone the passive route that we previously explained.
Absolutely correct. Is the I think prevailing market wisdom, and I think by and large is the truth. I think I agree
Yeah.
with that 99% of the time for most people. Um,
Well, listen, like if you're putting money away, right, you're probably making money somehow.
exactly.
If you're making money somehow, then you're probably good at that.
You should be focused on your comparative advantage,
Yeah.
as Professor Hank Bessenbinder said on this one of the podcasts I was getting prep for this. But he was talking about he wrote this interesting paper that is titled "Do Stocks Outperform Treasury Bills?" And that's an interesting way to get your attention. And he found that by and large, he's talking about individual stocks, not the stock market as a whole, but individual stocks by and large do not outperform treasury bills. Do not. You have, the reason that passive investing works is there are 90% losers and 10% winners, but those 10% when they win big. Big, 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 big. So if you own everything, you're guaranteed to get those 10% big winners that go from 100 to 200 to 1,000 to splitting 5 times to, growing, 100x, 200x of the initial value.
NVIDIA.
Yeah, hi NVIDIA. We're talking about you. That's where so you don't care that the other 90%, ultimately probably are going to go to zero because you end up getting those large returns. So individual stocks, by and large, if you're just sitting there picking individual stocks, you're probably better off just buying some T-bills, or putting your money in a mutual market fund, or money market fund rather,
or just buy the whole market,
exactly. And I think by and large, that's a big portion of what I do is weighted around having significant chunks of large indexes. I think a good 30-40% of what I allocate is towards the overall market as a whole, knowing that that's a great backbone to start from.
Great backbone. And like a quick aside, how do you think about it in terms of cash versus just allocating to something like VOO, right?
It depends what my cash needs are going to be. If I have something that I anticipate needing cash for in the next 2
But how
years,
soon? You can sell VOO in a day?
no,
T+2?
but VOO could also go down 30% tomorrow.
Yeah, it could.
I know it's not likely. But I'd say I like to have maybe like 3 months cash on hand, probably three months worth, and then try to keep the rest generally stored away, unless again, like maybe we're saving for something specific. Like I might put some into a mutual fund or a money market fund rather, specifically towards like allocated for that, where it's gonna I'm at least gonna get 5% interest on this while I save for this for the next 12 months. I just don't want it to take a hit while I'm building up the down payment for the new house or a new car or whatever.
Right. So, but you're giving me a little bit more, like a little bit of a perspective from a personal finance side.
Oh,
what about portfolio? What about portfolio management?
I'm sorry.
No. I mean, both perspectives are useful.
Yeah, I think from a portfolio management side, I believe that having a healthy cash position at times is good, and I like to honestly, I probably keep 20% cash a lot of times, waiting for something to come around, and then I'll get times where I get levered. It depends. I'm looking at what I think is again when I want to be buying. A lot of times I just want to be dollar cost averaging in and saving a little bit of cash for a day when it's going to rain, and when it rains, I'm going to be there to soak it up. So I think you have to build a little bit of cash. I think honestly carrying 20-30% cash at times when the market's frothy is probably not an unhealthy thing.
Yeah.
But
so you want to be. Here's a book recommendation, Red Notice by Bill Browder. You want to be Bill Browder in 1989 or 90, whenever he got his start, right? Mm-hmm. And the entirety of the Russian people need bread. They don't need stock certificates. So there's 16 Russians who don't need bread. They have plenty of money. And Bill Browder, I'm way oversimplifying and making it dramatic, but it's basically like this. And Bill Browder and his other Russian counterparts, not together, but they buy up as many stock certificates as they can. And here we have the oligarchy and Bill Browder, who made great money with a hedge fund that was, specialized in Russia and its opening.
Mm-hmm.
Great book, highly recommend it for so many reasons. It's not just money and hedge funds and stuff like that. It's like travel and geopolitics and risk and murder and him fighting the US government and so many things. It's really good. But anyway, he didn't need bread. That was his advantage. Right? Like they were trying to get these stock certificates in the hands of the populace, and that didn't work because they didn't need pieces of paper. They needed bread.
Yeah.
Essentially.
Yeah, that's interesting. That's an interesting analog there. I pulled it up and added to my queue. So I'll check that out for sure.
Yeah, I think I'll enjoy it.
But no, yeah. Again, like the question of like in terms of portfolio management, your cash position, I think it's when you're because we're talking about the way I'm approaching this is from an active standpoint. I'm going at this actively, and I need that cash at times. But there's times again when I'm going to take it down to zero if I feel it's right. It just really depends upon if there's opportunities where I see that are, hey, there's a giant and arbitrage opportunity here because Twitter is trading at half the value that Elon's going to be forced to pay for it in 6 months. Yep, let me go hit that real hard because I'm going to make 50% real quick.
Yeah, and it's a short-term trade, right? You're going to get if you're right, then you're going to get your cash plus back within a short enough period of time that like you haven't really put the life of the portfolio at risk, more than likely.
Mm-hmm. And keeping a healthy cash reserve allows you to take advantage of those opportunities. Now, of course, when I'm for different clients, it's different perspectives as well. Like each client that I work with is very specific on where they're at with their life cycle and what their goals are as well, and how they are towards wanting to embrace or not embrace risk. Their own personal taste towards risk is a big portion of what goes into that consideration, because some people are wisely risk averse, some too risk averse. You have some people who are just wild and would rather buy all the calls and be as leveraged as possible. So
yeah, that's where I'm at in my life.
The nihilistic investor.
Yeah. Man, all right, but like, and it's also like that you and your service through FIG could be not the entirety of their allocation, right? Like,
absolutely,
somebody might be coming to you and saying, like, I own a business, it's worth this much. I own $20 million of real estate, and I've got this cash pile. Most of it is in this boring target date fund, but I've got this like 250 sitting here, not doing anything. And
exactly,
if it lights on fire tomorrow, I'm still eating, I'm still drinking, I'm still traveling, I'm still working. It's all fine, right?
I don't even miss this. I don't even know it's over here. Yeah. I have a couple clients that I work with that are kind of like that. I like working with them. They're fun.
It is fun because it gets you and your juices. So speaking of active and passive, right? Like you can, it's not necessarily easy because everyone's life is so complicated, but like the way of allocating for a certain percentage of people is simple. It's more of the relationship and the human psychology aspect that is tricky and demanding. I don't know if that's the right word, but then it's a whole different like set of muscles in your brain that start working when you're like, okay, risk appetite is high. Let's try. This will be fun. It's an experiment.
Exactly. Yeah, and what's mispriced right now? What's the market missing right now, or what might I have a comparative advantage on realizing that somebody else doesn't?
Which your industry experience has something to say about that.
On certain industries, and I think in general manufacturing and general production, like industry, I can look at a balance sheet and have a pretty good feel for what that company's like. I can just get a feel for how they're governing themselves and how well they're doing it at focusing on their core mission. But yeah, there's other industries where, like, if you ask me to talk about biotech, that's a much harder thing to get your head wrapped around in my head.
Yeah, for sure.
Yeah,
I mean, talk about call options. Those stocks are call options oftentimes.
Yeah, honestly, that's
most of them are headed to zero quick.
Yeah, most of them are. Some of them will have they're funding a research on a new medication that Pfizer will want to buy, and will snap them up for billions of dollars. But again, it's where if you own a basket of 100 of 1,000 of them, you're going to get those winners, and those winners can be, ultimately what you want. Now, as an active investor, I'd tend to stay away from that sector a little bit more, aside from specific trends that I might be working on following, because it's like the understanding like the importance of the different like phase 1, phase 2, phase 3 trials, what that means in terms of like if it's going to
there's a whole
actually
vocabulary
be
and language
able
around
to,
all of it.
It's very complex.
Yeah.
So like there, I don't have a comparative advantage, so I tend to stay less active in that area, and I'll
sure.
rely more on getting that exposure through another index or buying an index that is focused around that.
But
you gotta know what you gotta know and know what you don't know.
I think we just demonstrated there is this magnetism or gravity to active for some people, and it's never going to go away.
Well, and I think what's fascinating is you absolutely need it. Like if everybody out there tomorrow went and said, we're all going to be passive investors, the system breaks. It will stop working, because then you have lost.
Explain stop working.
Okay.
Why does it stop working? Or I mean, like, what I mean.
Okay. What then happens is we have people that are buying into companies that are becoming more and more overvalued relative to their actual merits of what they're producing. So again, like all of a sudden, NVIDIA goes from 100 to 1,000. Well, is that warranted? Well, if you look at their earnings and what their earnings have done, actually, yes, I think it probably is warranted. Yeah. And I think a lot of people miss that. But there's other stocks that go have those run ups, and then if it was a passive index, like these prices would basically stuck forever. We would never see a change in relative value of anything. If we never had another active investor, everything would just be relatively valued what it is today, constantly number going up. And okay, maybe that works for a while, but
it's fake. It'll fail.
But it's fake. Eventually, when you have,
let's go back to that smallest company in the S&P 500, right? Like,
yeah,
it's just in the index in a functioning market. If its revenues decline, if it declares bankruptcy, if it has a huge scandal and it can't sell its product anymore or service, whatever it does, then it should be dropped from that index, right?
Correct. And then if there's an index that tracks the, or then you would go to the next largest company that was outside of the index that would be, become more valued relative to them and pull them in. So like right now, I just pulled it up. News Corporation Class B is currently the lowest market cap weighted stock on the index. Fox, I think it is. Yeah. Fox Corp Class B is right ahead of it, 502. And then Paramount Global Class B, which is not surprising given the bitter.
These are like household names. I didn't think the bottom two would be household names.
Yeah, like if you go up in like kind of if you go into the like 300s, there's some like ones you've never heard of, I'm sure.
Yeah.
Well, I mean, I've heard of like Zebra Technology Corporation. Probably most people haven't heard of Zebra.
I know Zebra.
Okay. Telenova. I'm not sure what they do.
Nope.
IDEX.
Olive oil.
Yeah. So like.
Okay. Yeah. So anyway, I mean, I think there's still this, or at least in my mind, there's still this like piece that is hard to understand. So if we all only owned VOO and it was like that, I mean, there was like an ETF for stocks, there was an ETF for broader stocks, there was an ETF for international stocks, and there was an ETF for bonds, and that's like it. What did I say? 4 or 5 different things. Those are your only choices. Everything is passive. All the money piles in. One, you've lost competition among the people who actually run these ETFs, right? We haven't started talking about costs. But 2, like what functionally in that scenario breaks the market?
Once you have one day of bad sell-offs, I think you could end up having like a cascading effect, like where you've built this
a bank run, essentially. But instead of it being a bank, it's
because right now, because one thing that happens right now is if I'm going in and putting $1,000 in my 401k this week, and I'm buying $1,000 of VOO, somebody else is selling $1,000 of those 500 stocks that comprise it, right? So who's the seller? So we're assuming that there's a seller providing us all these things as we're buying. If we're all passively buying, there's not going to be active sellers. because things are so your liquidity will get a little messy. Also, I think
It freezes the market cap in time.
yeah, it freezes the market cap in time.
No?
Well, the relative value. That's what I was saying earlier. It freezes the relative
Maybe is it-
valuation. I think the market cap would still
yeah.
go up or down, but your relative value wouldn't change.
Right.
And
Better.
yeah, and like there would be no point in owning any one thing because it's the reason that things increase in value is people want to buy them and they want to own them because they think there is a better case for owning Nvidia than News Corporation, for example. So more people want to.
Why do housing prices keep going up?
Yeah, because people ultimately
There's an imbalance of sellers and buyers.
exactly there's an imbalance in sellers and buyers, and what people are buying in the cases of these is rights to own, a small percentage of ownership of that company, so that I am entitled to a percentage of its earnings and cash flows. If they ever start paying dividends, I'm entitled to a dividend. If they are part of buybacks, my shares are going to get bought back and drive the overall shares of my prices up overall, hopefully, and then I'm going to be able to sell them to another person who wants to own them at some point. As when they are in theory in the future.
Long live the buyback.
Yeah, long live the buyback. We do not need to be messing around with that with what's going on there. I don't know. I say that, but there was a lot of talk in the last year about buybacks. Like, you guys are not understanding what's going on here.
Yeah, that was. Yeah,
they do not get it.
Fundamentally do not understand.
Yeah, they fundamentally do not understand the math, the system, like what it does for everybody, essentially.
Yep.
And how capital is returned to.
That's a whole nother.
Yeah, that's a whole nother thing.
That's a whole nother thing. Yeah.
So prices become stuck in time, and then also if you have a market shock, I think in the situation of a market shock, you have a much larger potential for risk of ruin, much larger potential for a giant recession or a depression, essentially, because prices are.
Because I think we already see that in our market the way it is, right?
Mm-hmm.
Like, that's the only way. That exact behavior is how you end up with a down 40, down 60 situation, right? Now, if you make everyone like a layer abstracted from the actual companies, and there's only 4 or 5 instruments to buy, and everyone goes to try to sell their stuff at the same time, I don't think it's 40 or 60, right? Because in the 40 and 60 scenario, there are some enterprising, often active buyers.
Yeah, saying, "Whoa, you're selling at what price? Yeah,
right?
I'll take that, please. That's going to return the capital 2 times over in the next 10 years. Let's do it."
Yeah.
And I think that's where.
But on the other side of
go ahead.
Okay. but on the other side of that, like, I think this is where there's like we said some of the labels are squishy. This is where I get a little squishy on the active and passive bit, because if this scenario were to be real and there's only 4 or 5 instruments to play with, then inevitably you would have the active behavior would emerge.
Right.
I think it's emergent.
I think you're right. I think you're absolutely right. But a lot of sources, I read a couple different sources or listened to a couple different sources that quoted numbers of what you need to maintain the idea of an efficient market. Like, that's ultimately what we want, is to have an efficient market where the price represents as close to possible the true
reality,
real value. You can argue, well, maybe we value things more than others for the wrong reasons. Maybe, we ascribe more value to one thing over another for things that don't necessarily make sense, but at least we all agree that that's how we value it right now. And in the future, things can change and change our perception of what that value is. And that's what, as an active investor, you're looking saying, well, today, this is what people think of this. Tomorrow, I bet they're going to be thinking this instead. And that's going to drive that up, or that's going to drive this down. And I want to be, again, buying or selling based upon that viewpoint and having that opinion, and acting on it, I guess. For me, I think one way I also approach, some of my active investing is saying, okay, if I have this market of 500 companies, I know for sure, not all of them are going up next year. Like some of them are going to go down. It happens where not all of these can be performing at the same level. If we're talking about, you want to look at your average performance of the S&P of 500 over the last 10, 15, 20 years, then that's a a compilation of those 500 companies. Some were doing above that, some were doing worse than that. I think there's a lot of value, and I think it's possible to go and say, hey, based upon what we have, what we can see from the company's financials, and what we can learn from studying, reading news sources about what's going on in the world, what might be impacting the markets for these companies, understand that, hey, that one is probably going to be worth less relative to the rest of the market next year than this year, or that one's going to be worth more relative to the rest of the market this year than next year, and basically have an index, but then say, I'm going to overweight these 10% or these 20 companies, and say I'm gonna still buy most of the index, but I'm also going to go and say I'm expressing my active views through position size rather than just a pure own not own. Because also sometimes you're going to have a surprise in the bottom 50 companies you thought would do nothing, that one of them does go, whoa, what the hell? Where did this come out from nowhere? So sometimes you don't want to necessarily not own them at all. But if you own them in small value, you still get the power law effect.
That was great. So what I'm looking for right now is you had pinged a friend.
Yeah, I know.
About their.
I'm looking for that too. I was looking for that.
Sean and I text a lot, and that's right now it's a problem. Anyway,
when you talk about passive breaking the market, I think it'd be interesting to touch on, is that a bad thing? Like, if I only ever buy S&P 500 funds, isn't a broken market what I want? A constant return is essentially the idea. So have we
did address that.
Yeah, we did.
I don't know if we put a bow on it yet.
No, maybe we can. We can.
If you end up incentivizing zombie companies to keep moving forward and to keep gaining ground and to keep earning your dollar, even though they aren't doing the things that got them into that index in the first place, then you have a dysfunctional. You're headed down at that point, because it's at some point it's a Ponzi scheme at that point, and it will break eventually.
Exactly.
And then you'll be without your money.
Why have we not thought of the word Ponzi scheme for a pure passive market? Because that's almost honestly what it kind of becomes if it's purely passive. It ultimately becomes a Ponzi scheme in a way, I think.
Okay, but this requires absolute purity, I think.
Yeah,
right?
So it would have to be absolute purity.
True.
Yeah.
Like, we've played with the scenario of there are 4 or 5 different passive vehicles, and for the most part, money just piles in. But then you play with that scenario a little bit, and you're like, well, if there's 5 instruments that people can choose from, when things get wonky, people will make choices. There's going to be at least some significant percentage of managers or people or funds or whatever that start making choices, and that will force the market in a particular direction.
Absolutely.
Or to trim some of the fat, or
and also we have to consider no, you're right.
Yes.
you gave me a thought, and I lost it. It doesn't matter.
As soon as I did that, I was like, that's the, it's, I would never do that if I didn't have half a drink of it.
Yeah, like one drink, it's all right.
Like
right?
A cute little opportunity.
Yeah.
So I think the place that we should be going to now is, unless there's a different direction you want to go.
Where
okay.
Lead it, steer us away, Dan.
Einhorn is a celebrated, storied investor. He runs Greenlight Capital, and he is pretty good about getting his message out.
Why is he famous, Dan?
That's one of his.
What was his first claim to fame? Do you remember? He's a short seller of a particular stock. He shorted Lehman going into their bankruptcy.
Did he short? Okay.
Yeah, he made a bunch of money saying Lehman's going to collapse, and he was right. So yeah, he did.
Okay, so that scene in. No, never mind. Different scene. It was that scene in the movie Big Short, not the book. I think the book probably used accurate names. Where they have Mark Baum, which isn't his real name, and this other investor. I don't recall if they even named this investor, but he's just sort of like a pump, this is the U.S. government, this is the U.S. stock market, blah blah blah.
Yeah.
And Mark Baum's position is basically like, yeah. Evidently, that was based on Bill Miller.
Okay.
We are getting off topic already.
Yeah, we are.
Anyway, Einhorn does a good job of getting his message out, and And he's long released his like quarterly investor letters. It's one of the letters that people really like wait with bated breath in order to see what's going on in David Einhorn's mind. He's had a string of pretty rough years, as pretty much most value investors, especially like the value school of investing. Those investors, I worked for one. It's there was a ZERP changes things, and now Einhorn's message is basically like, I can't do my job. Well, this is an exaggeration a little bit, but I can't do my job. Passive has broken the market. Active isn't working. Even though he's strung together a couple good years now.
Yeah. I also think, though, going back, and I've listened to it a few times now, to what he had to say on this topic. And one thing he also really talks about that I think is interesting is passive breaking the market, but also what you just said, ZERP, where there was too much free cash that was basically
didn't have a home.
Yeah, didn't have a home, and keeping a lot of sick companies running was another big part of it. And that, like, he at some point, though, that we think that inflation is this. He ties this back to inflation as well, where we think that interest rates are going to help drive down inflation, but at some point they also become inflationary themselves. Is kind of another point that he weaves into that overall argument of how passive investing, coupled with, I think, ZERP for decades, really broke a lot of the fundamental aspects of how he views the market should act, and that people are basically, you can be yelling and screaming, hey, this thing over here is super cheap, but nobody ever seems to care. It doesn't matter. Nobody ever wants to end up, owning more of it, even though it's doing good things. And
because GameStop is over here, and since everyone's buying it,
yes,
you're forcing a price up. Like, I want to participate in that. That's a quick dollar.
Yeah, but like, you can't actually there's like people, there's not enough attention space to understand the 700th size company in the US and say, this is a really good value in relation to these others, when you have these other ones that you're always thinking about and hearing about. Like, it's very hard to fundamentally build enough momentum and interest in those names. And when you have everybody just passively indexing, that they're already buying a set percentage, they're not even interested in listening at this point, essentially, because it doesn't matter to them. So there's a smaller audience for the people who are trying to set prices, and I think he's saying that there's inefficiencies. Basically, the efficient market hypothesis is breaking down because there aren't enough active investors at times. But I also think
But if the market is less efficient, doesn't that provide more opportunity?
Right. But I think what he's also arguing that the efficiencies then are becoming baked in, and they're not correcting. They don't mean revert anymore. Like, things don't mean revert the way they used to.
I can understand that. I also feel like there's certain, like, ZERP lasted a really long time. This, higher for longer, probably going to last for a really, really long time. I just wonder if there's certain sort of like government aspects to our economy that are going to be static and stale and longer, and the other corrections, let's call them, are shorter, right? Like when Muddy Waters research releases a fraud, blah 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 blah, and it ends up being true, like that message doesn't take 6 months to play out. It's like days.
It's days. Yeah. That's I think a counterpoint. And honestly, I think one thing I disagree with Einhorn's argument is a lot of it, I think, is based around he had some bad years, and he's like, why is what I'm doing not working? And I think a lot of what it was because his, sometimes it's a patience game. These things that can take years for the value to be recognized, and he might ultimately be right that they were good companies and worth the bet at the time from his perspective, but that at the time, though, everybody else wanted to own Amazon and FANG, and
being early is just as bad as being wrong.
Exactly. Often. I think often,
and it's a real hard thing to take.
Yeah. I think a lot of what I heard in what I was hearing was some of that sentiment of, like, it wasn't necessarily that he was wrong, but that things didn't. I don't know. I'm probably reading into a couple interviews I heard of him a bit too much, but
I think it's a fair read in. Like, how much of that part of it is weighted, I don't know, but like, I agree with you. I think there's an amount of that,
yeah,
and that's being I feel I worked for a guy that was kind of like Einhorn in certain styles, and certain orientations towards the markets and how they're supposed to operate. And I felt like there was a similar thing going on where it was like hands up in the air, things are broken, nothing's working, like, and I'm sitting there thinking like, I agree, it does seem broken, but the problem is if it's structurally broken because of the government and the government isn't changing, then you are playing a fundamentally different game, right? And this is another hard piece about becoming an investor is there are multiple games at play, and some come in waves and seasons, and you might have to just sit on the sideline for 15 years and if you can't adapt, right? Like if you're really good at one kind of thing, and that's not what it's play because it's become unfair or skewed in some way. I mean, we only have so many years to live. That can be real. It stinks.
Yeah, exactly.
Or hard to swallow.
Well, and that you just said something that reminded me of something interesting. When you're talking about, one reason I think that people have moved away from active to passive is that it's very, very, very difficult to outperform the market. People say on aggregate, I'm going to do okay if I do this. But the thing is, it's also very difficult to tell if an investor is good or bad relative to the market, because we're talking about things that, as we mentioned, time cycles don't necessarily align to the way we want them to. It's like, well, this quarter was up, so therefore it was good. Well, this quarter was down, therefore it was bad. That's not when we're talking about long-term compounding, it takes much longer to actually determine true success versus the market. And something fascinating I heard from Professor Kenneth French, it boggles my mind that you can go out and hear a podcast from some of these people who have written fundamental economic theory that we are using, and they're still alive, and you can listen to them talk about this stuff. It boggles my mind how new some of this stuff really is. But his statement was, well, I'll ask you, how many years does it take to determine if an active manager actually outperforms the market? What was your initial guess?
My initial guess was 3 years.
Yeah. And that was off by a factor of, I think, 20. It's about 60,
don't be so mean.
64 years, I think, is what he said. Where, to statistically say, yes, they are statistically better or worse than the market, it can take 64 years. Now, I think on the downside, if they're worse, you get that a lot quicker. I think if they're truly worse, but maybe not. Maybe not.
Are they though?
I don't know.
They though?
Maybe not.
What if Einhorn started? What if Einhorn started on the day that ZERP started?
Yeah. Right. So his what he had been working on before, just these trends, I guess, come and go, is ultimately what he was kind of saying. In that there are, he basically was saying that he himself doesn't passively or doesn't actively invest, but that again, you need active investors out there to help discover efficient prices. But it's also one of the reasons it's a very beat up industry is because it's very hard to prove outperformance, and everybody feels safer in passive, so that you end up with a much larger weighting there. He had a lot of much finer points that I'm totally not recalling to mind.
We'll have to find that link and put it in the show notes. But
I'm going to put it in the show notes because all of the content I consumed to help inspire this conversation and give anybody who's listening who finds interest in this topic, if you want to dig more from some real true experts, they are out there if you know where to look, and we'll point you in some directions.
They are out there. So, okay, I want to try to steer it back to because in order to sort of talk about the finer details of an attempt at answering some of these questions,
yes,
you end up having to make a controlled experiment, right? So it's well, if this and that equaled this structure and then ran the experiment, then we believe our theory would be that you would have this approximate outcome. Back to the real world, where there are not 5 or 4 investment choices, there are an infinite multitude. The ETF game has broadened a lot, right? So I know the majority of dollars are going to instruments like VOO or some sort of bond ETF or whatever. However, there are also some really interesting flavors out there. Some are like more actively managed ETFs are coming, or managed futures funds. There's a whole bunch of there's a whole
I'm
other
thinking
library of things
I
going on.
I love what who is it? RSSY. Corey Hoffstein and Alpha Architects? No, that's Wes Gray, Alpha Architects and Box. What's that fund?
AQR?
Return stacked ETFs. There we go. Return stacked ETFs have a really interesting some managed future ETFs that they just released a couple months ago, and they're interesting instruments in what they offer. Go ahead, Dan. I apologize. I should have cut you off.
No. I think you have already explored the space more than I have, right? So like being able to talk about specific examples, but so in order to, there's a couple things I feel like are worth highlighting in terms of illuminating the world that we actually live and operate in. One is, if you're going to go pay an active manager, historically you would be paying 2.20 ish. So on all the dollars that I hand over to my active manager, they're going to charge me a 2% fee. And that pays salaries, that pays lights, that pays utilities, that pays data market stuff. Like there's a whole lot of expenses in order to run one of these businesses. These days, if you don't have $100 million in AUM, you don't have a business. And it's probably really hard to run at 100 AUM.
Honestly, yeah.
Yeah, for sure. And then if they have, let's say that they return a 10% return to you over a year, they're going to take 20% of that 10%. So
you're left with 8
as their fee. And historically, this is how many fund managers. There's two ways to get really
6 if you net out the two
really wealthy as a fund manager.
Yeah,
you either do really well by your investors and make a bunch of money, and your 20 is worth a lot.
Exactly.
Or this is the really, really cynical view. You get better at raising money than you are at managing money, and you make your pile as big as possible, and then that 2% starts to become extremely valuable. And the 20 doesn't matter as much. It's more about years duration and the size.
That's
a little bit of like,
because I mean,
but those are really,
real,
really, those are really, really high fees. It is very real. It is very real. Those are very, very high fees to pay for active management. Now, there was a day when like those were often like really worth it, but now the stats kind of bear out that maybe it's not, or it's really hard to pick a manager. There are so many to pick from. Versus like I can buy VOO at what, 3 bips? That's 0.03%. Is my fee on buying VOO, and I buy the best 5.
Yeah,
I don't.
That might be lower than that. I don't even know. I'm looking it up now.
And then I owned the best 500 companies trading in America, right? Like the value proposition there for basically everyone is pretty clear.
Right. Three bips. You're right.
And now you could go to, what was their name? Return Stacked, or another company that I know of is called Simplify. And they have these sometimes very esoteric, but also very interesting ETFs that you can deploy in order to exercise a particular thesis within your portfolio, right? Instead of having to know or to buy 10 different stocks or instruments or whatever in order to express your view on, say, 10% of your portfolio, just allocate 10% of your portfolio to one of these ETFs that is a whatever active. It doesn't even have to be active, but like you can express different things through these ETFs. I think it's a really interesting shift. So anyway, these other esoteric, you'll see much higher fees. They might be 1.5%, or maybe some of them are more than that. I don't know enough to be able to say, but like the fees can be substantially higher than 3 basis points on VOO, right? But at the same time, it's not 2.20.
Exactly. Well,
so if you could construct a semi-active portfolio with great managers through ETFs and end up paying not even a handful of percent, like across your 10 bets or whatever. Exploring this topic made me want to explore ETFs more deeply and see if there are interesting portfolios that I could construct with just 5 or 10 ETFs, expressions, let's call them.
Rooster's been doing a good series on ETFs lately. I don't know if you keep up with him. He's had a number of good ETF centered guests on. So I think maybe we could try to kind of put a bow on the high level points of what passive could, in theory, be doing to impact the market in a way that creates effects that people might not consider, that might be harmful or helpful to them. Because I think, as we talked about, there is some question of like, well, at what level is passive breaking the market a bad thing, right? If number go up, do I care? Or why do I care?
Or speaking of, or going back to Zurich, like, if this is just the reality, then don't we as investors need to adjust to it?
Yes. Yeah. I think that's right.
And
Exactly.
then, how?
I think it's how do we interact with that information? I went back, and Einhorn mentioned specifically listening to the input of one Mr. Michael Green, and so I found some
Of Simplify.
Of Simplify. Yes, Michael Green of Simplify. That's exactly right.
Former hedge funder, moved into the ETF space.
And so he had some main points around what he thinks are negative impacts from passive investing growing to the size that it has. So systemic risk is, I think, the one that we keep coming around to, where the growth of passive investing, basically in times of market stress, the actions that passive funds take can amplify market movements, and on a downswing, it could amplify it to the downside, essentially. Where I think that's where, to me,
making recovery harder and more expensive.
And I think, to me, that's really one of my larger concerns with not enough active managers potentially having an influence on the market. And if prices truly are mismatched, and we do have a need for a future, culling of prices, like it could really make that a much more painful experience than it needs to be if things are over inflated because of
especially when only some percentage of those active managers are gonna do what needs done.
Yeah, absolutely.
A lot of them are glorified. Well, I shouldn't say a lot of them, but like, it feels to me like there's plenty of them that are, I don't know.
And I think
not any better than the ETFs.
Yeah, exactly. And then also, there's also, I think, Matt Levine's kind of written about this, and I think Green talked about it as well. The idea of weird corporate governance situations that can arise, like if we own, as investors, the same 5 auto companies. Do I want one to do better than the other necessarily, or do I want them all to do well? Do I want them to kind of collude and fix prices? How much do I necessarily want them to compete with one another? So you get a weird, and I think this is again very squishy in my mind, because it's very hard to say, well, yeah, because because just because we own it and we're shareholders, there's not people actively going to the board meeting saying, we want you to go do this. It is practical to think that there could be large shareholders that are going and doing some of that behind doors that we're not in, rooms where we're not invited. That do you basically create anti-competitiveness within the industries, within industries, by basically having common ownership of the group of companies? I think that's an interesting, compelling argument. That's
a good question.
Philosophically, yeah. Functionally, I don't know. I have a hard time really wrapping my head around how that works functionally. I feel like it's such a conspiracy. It's too complex for it to actually work. Like,
exactly. Yeah. Yes.
Yeah.
It's like listening to conspiracies about 9/11. It's like, I don't think you guys know how complicated the government is. I don't think they could. You think
even
if they wanted to, I don't think they could have.
You think anybody could keep a secret in this country, for Pete's sake? Come on. Fuck off. Yeah, so I those were some other interesting points that I think that Einhorn didn't necessarily get to, but I thought that also were informative of some reasons, possibly against everybody going to passive all the time. And again, I think for probably almost every listener out there, I would say you probably should be passively investing or having your money managed by an active manager if you're of of a certain level where you have disposable income, or you're very comfortable with risk, or you have the means. There's a lot of test cases.
You have the means.
Yeah.
A lot really comes down to. a lot of that.
A lot of caveats on that, but I think that having active, people actively out there trying to find and assess the value of these companies does keep the valuation somewhat honest. I think by and large, I think these arguments are not so much to think that passive investing has broken the market. I think it has changed the market. I think it does impact how we as investors should react to things, and we should be mindful of these things. And I think it's giving rise to one. It's given rise to this new theory that's recently been put out called the inelastic market hypothesis, which I think is very interesting.
Inelastic market.
Inelastic market hypothesis. So you have the efficient market hypothesis, and now you have the inelastic market hypothesis from Dr. Ralph Kojan from University of Chicago and Xavier Gabe from Harvard. It's a working paper that they have published right now. It's still ongoing, but they're positing that for every dollar you go put into the S&P 500, how much does it go up? If I say I'm going to go put $1 into the S&P 500, how much does the S&P 500 go up? Guess. It should be $1, right? I put
across
one more
the entire
dollar.
S&P 500.
Yeah, if I put $1 in, like into an ETF, an S&P 500 ETF, what does that do to the relative value of the S&P 500? It should be $1.
Yeah, okay. I was trying to work out a percentage. I'm like, I need more numbers.
No. like I put in $1. Like the relative value market cap should go up by $1 because I bought in for one additional dollar.
Yes,
I've invested one additional dollar. In actuality, it fluctuates from 3 to 8, and they are saying on average about 5. So for every dollar you put in, the market cap goes up by 5.
Why?
So think about that leveraging when you have then the inelasticity on the downside. If people start to withdraw, like baby boomers starting to like cash out stuff, if there weren't enough people coming in to buy it from behind them, you could have then a major, huge drawdown. Again, this is a working paper that is published, I think, 2021. They've been making updates on it continuously. The math is mostly over my head, but I've read through it and tried to grasp what I could, and it is really a compelling thing to think about when you think about what that means in terms of the risk of if all of a sudden everybody says, well, you know what, we're not going to invest in stocks anymore, but we're going to start investing just in real estate. Instead, everybody starts building houses. Then there's not this money coming into the stock market. What happens? Like there's other things that people could put money towards that could impact how all of these things are valued in the future, and we need to be aware of that. Anyway, that was just a really interesting, I think, a really interesting bit of new financial research on that financial engineering frontier. It's really still a lot of techniques and ideas that are very new in relation to a lot of our other mathematical foundations, compared to what how long we've known about calculus, and how long we've known a lot more about harder sciences before this. Economics is very soft science, and a lot of it is constantly changing and constantly evolving, and a lot of what we're talking about will probably be outdated in 10 years too. So get with a grain of salt.
Yeah. It's a complex adaptive system, right?
But my opinion though is I do not think fundamentally the market is broken. I think it might slow down the movement and recognitions of mispricings. I think there are risks that cascade and can self-perpetuate from flow interruptions with too much passive investing. But I also think that some of that is driven by the nature of the beast. I don't know how you change that, because more people are buying stocks today than they ever have before, right? I mean,
yes. Well, there's more people own the companies of the stock market than ever before.
Yeah. So there's more demand. So
I don't remember this.
Naturally, prices are going to go high because demand has gone high. So unless you have the change for these investments on the demand side, I don't see I don't see it changing.
Well, couldn't you make the argument there are more companies now? Like the S&P. How long has the S&P 500 been a thing? Right? Were there 500 companies of?
It's the opposite. There's a lot fewer
the Dow
companies
Industrial's
today
been around a long time, but
Yeah, there's a lot fewer publicly traded companies today than there have been ever. Like if you look at
by number
like
of
by
companies,
number of
right?
publicly traded companies, yeah, it's like 60%
But
off from.
but what about like inflation adjusted revenue or something?
That's a good question. Like you mean like where like what's
Because
the
I feel like if you were to cut it that way, or something approximate to that I'm aiming for, then you'd end up seeing something like Standard Oil be like 59% of the S&P 500, and then you know where I'm going. Like the history on this is kind of like comparing ourselves to way back is hard, because like the structure of the market has changed and evolved so much, and the structure and the structure of the investors has changed too.
Mm-hmm.
So like, yeah, I mean, I get your point, and I agree that the demand has gone up, but at the same time, I feel like there's more places, more safe places, more well-run places to be able to allocate these dollars.
Mm-hmm.
Whereas, I don't know, what's the guy's name? Reminiscences of a stock operator.
Livermore, is it?
Livermore. Like Jesse Livermore. Like take someone like him. I mean, it's just straight up gambling.
Yeah.
And I know there's a bunch of people who still walk around today thinking like any investment in the stock market is just gambling. But functionally and structurally, there's way more going on here. And it is good for the broader economy and the majority of people. I don't know. Yeah.
I think for me, the button on it is that it's ever evolving, it's ever changing. Whatever we discover today is going to be applicable for a while until everybody gets on board, and then it like even as you make these discoveries, people start using applying these new processes of thought in financial tools. Like thinking of like the January effect was a thing that was noted as working for a while, where what would happen is particularly in like small and mid caps, you'd see a decline in certain prices companies as people at the end of the year would basically be stock loss harvesting and rebalancing portfolios, and then go back and then they would rebuy a lot of these stocks in late January. And so you'd see this spike in January on like certain size, like certain cap sizes, where they would just always have this big run up. And then once people knew about that, then, oh, well, that broke. Like, it stopped working because everybody then like realized what's going on there. And so I guess what I'm saying is, even as we learn more, just the act of then putting that knowledge into practice and into use then changes the system, and it then evolves to what we're doing. So it's never static. It's always dynamic. And I think that's
complex adaptive.
It's complex adaptive. And yeah.
We will keep coming back to that, because there's no way you talk about any sort of thing in finance or economics where like what you're doing is sort of measuring the behavior of a bunch of humans all at the same time. And by definition at that point, it's complex and it's adaptive, meaning it changes on you. Just when you think you've got something under control, in order to measure it, it slips away.
That's the truth.
Right?
That is the truth. And I think that's why you and I are interested in it, is because it's a puzzle for us, and it interests us, and it keeps us thinking about the what ifs and the what nexts in ways that other things don't necessarily afford the opportunity to do that. That's not necessarily true.
Totally. And you can end up like attempting to extrapolate, right? And that's where you're like, as an active manager, you would be trying to express those hypotheses.
I agree. So from a again, not advice, but advice standpoint, I would recommend, like most people out there, if you're an investor getting started in investing, passive investing is the way to start. Active management should be considered for people of certain risk appetites, or again certain means. But don't let, if you hear these stories and you see these things in the media saying passive investing or this is breaking the market, it's often somebody expressing a view of something that they were doing is no longer working, and they're kind of bitter about it. So take all that with a grain of salt,
or they just might be fundraising.
Also true. Like adverse selection, right? What are they trying to sell you essentially with that by putting that information?
Yes.
So, that would be kind of my button on our active versus passive thought. And I'm going to continue to be an active investor, because I think it's again, we need some people out there doing it. So if you guys don't, the rest of you aren't going to, then I'm going to. Somebody's got to, right?
Somebody's got to.
Yeah,
I mean, I do both.
Yeah. Also true. Yeah, like there's also, that's also true. Like some people have a large, percentage dedicated to passive, and just have a little fun money that they're being active with. And I think that's a great way.
I think that's a great way to go about it. If you've got an itch to scratch.
I agree. Yeah, like if you want to take 10% and say, hey, here's my fun money fund, I'm going to go and take some swings at some calls or some different stocks that I think are going to have a potential big run.
Learn about futures and blow some money up or something,
Yeah, exactly. Like set your limit, know what you can afford to zero out, because there's a chance you might zero it out. But there's also, if you
there's a very good chance you'll zero it out.
It'll also teach you, give you afforded the opportunity to learn about the things that actually drive value and price in the market, and what ultimately drives long-term returns. There's no better substitute for doing something than learning how to do it by doing it, is my opinion.
Yeah, hands dirty.
Yeah.
There's no substitute for it.
Yeah, you have to have skin in the game to get your interest, and to understand that, because it's a lot of times is an emotional thing. I think that's what is very hard to put in a textbook, is the emotion side of what's going on.
And how you manage it, or maybe you're not built for it. Maybe you just don't have the brain for it, and not by mental firepower. Like there's average people that have the emotional skill set that are great investors, and then there are people with just gobs of mental firepower who don't have the emotional side of it. And this isn't, there's no judgment here. It's just sort of like, oh, this is kind of how you were built / grew up / whatever.
The first group all worked for Bear Stearns, and the second group all teaches at universities, mostly,
Is Bear Stearns still here?
No, they're not.
We need a different example. Yeah.
Goldman, I guess. Maybe Goldman Sachs would be a better one there. Yeah.
Yeah, maybe Goldman, a little Rentech, and then academia or whatever.
Yeah. Well, I'd say let's put a button on our discussion for passive versus active there for the week. And thanks everybody for tuning in and listening to another episode of Unqualified Advice. We hope you are a little more informed and enjoyed spending some time with Dan and I. See you all next time.
Feedback welcome.
Feedback welcome. Get at us on Twitter.